Okay. Good morning and welcome.
Good morning.
This is the New York City Employees Retirement System Investment Meeting, November 20th. Diane, would you please call the roll?
Chair.
Present.
Controller's Office.
Present.
Public Advocate's Office.
Here.
Borough President Manhattan.
Here.
Borough President Brooklyn. Here. Borough President Queens.
Here.
Borough President Staten Island.
Present.
Borough President Bronx.
Here.
International Brotherhood of Teamsters. Transport Workers Union.
Good morning.
District Council 37.
Here.
We have a quorum.
Thank you. We have the agenda in front of us. We have one addition. It's not really an agenda item, but there will be some handouts during the executive session with regard to governance training. Do we have any other changes to the agenda today? Okay, thank you. Larry?
I thought we were going to start with Mercer since they had some time constraints.
We're happy to do that. So is everyone okay with the change up in the order?
So I can offer to get them. I'll just preface, as we all know, we have Mercer Consulting coming here today to give us an overview of ESG, help us better understand ESG, what it is, what the value of ESG is for performance and investing, institutional investing, what other people have done with it, some best practices, and what a process would be for developing a policy, as we've been discussing. Jay Amashir and Craig Metrick are two folks here, which I'll bring in. And in the meantime, I'm going to pass out the sort of information for a conference coming up in early December on ESG that's being held at Bloomberg, and we have Dan Doctorow speaking at it. It's an annual, pretty well-respected conference that trustees might be interested in. Email this to everyone as well. Here in a second. I have to get the spelling for you. But one is Craig, C-R-A-I-G, Metric, M-E-T-R-I-C-K. Metric, M as in Mary, E-T-R-I-C-K. And the other one is Jane. And then I have to get the spelling. Jane. It's spelled A, M as in Mary, B, A, C-H-T-S-H-E-E-R. I got a copy as well. You have a copy? I have a copy.
Bring this next. Justin.
Good morning, Jane and Craig. Welcome.
Thank you.
We're happy to have you here and look forward to your presentation. You may go ahead and start whenever you're ready.
Great. Well, thank you very much for having us. It's a pleasure to be here. The purpose of today's presentation is really to provide some background and context around the trends that we're seeing around responsible investment and the integration of environmental, social, and governance factors into investment management, as well as provide some context and case studies of some of the other funds that we've worked with and some of the kind of implementation models we're seeing, and then talk about some opportunities for implementation from the NYCERS perspective. So I'll first talk through this slide deck that we have, and then we can have some time for conversation and discussion at the end. As you know, we're with Mercer. We have a 15-person responsible investment team located around the world. So Craig Metrick heads up our U.S. group, and I'm the global head based in Toronto. And we've also got people in our group who are in London, Sydney, Melbourne, and Tokyo. And we work directly with institutional investors to help them think about their responsible investment approach, as well as develop intellectual capital for use within Mercer by Mercer consultants and across the client base more broadly, just as context. So if we move into the first section of the agenda for today and talk a little bit about the evolution of responsible investment. So slide 3, you can see here a chart which shows the evolution from ethical investing to socially responsible investment towards what we now term responsible investment. But terminology is, to be honest, a bit of an issue in this field because there's a lot of different terminology that's used, sometimes interchangeably, even though it may not be correct to use the terminology interchangeably. And one of the things that each fund, I think, needs to think about is what terminology makes sense for them. So the evolution really has come from very, very early roots, actually in the 1800s, when the Quakers first started to align their investments with their beliefs by excluding certain investments. And that kind of ethical approach of excluding investments really has had the longest history in this field, and it's still how many people really perceive this field. But more recently, in the last decade or so, there's been a very dramatic shift towards what we term responsible investment, which we really define as the integration of kind of non-traditional factors into your investment approach. So looking at a wider set of risks and a wider set of opportunities. So environmental risks like climate change. How are they changing the investment landscape? How are individual companies managing this risk or pursuing associated opportunities? And is that something that you or your external fund managers and the companies in your portfolio are focused on? And that's really kind of this newer, kind of broader paradigm that we term responsible investment, others, CalPERS terms sustainable investment. So really kind of playing with a full deck of cards is how I like to look at it. And, really the foundation for this is the fact that the world is changing. Currently, we're operating way beyond the kind of carrying capacity of the planet, and this is not sustainable. McKinsey has come out with a great new piece of thought leadership called the Resource Revolution. It's on their website, a lot of really great statistics, looking at the drivers for this, what they call the resource revolution, for a shift towards the way that we measure productivity, much more focus on efficiency, resource management, and really a revolution in the way that things are produced and shipped and used, and that this will change the way companies and investors operate. And it's really getting ahead of that and being on top of that as an investor. I think from a broader paradigm perspective, that is what we're talking about today. Slide 4, you see a picture of a report that came out from the CFA Institute in 2008. There are a ton of these kinds of reports. This one I think was particularly important because it did come out from the CFA Institute, which of course is the most well-respected professional certification in the financial field. They describe a number of reasons why investors should consider ESG, whether it's the enhancement to enhance the security selection and risk management process. Looking at companies that manage these issues well can be a proxy just for good management, because these issues can be really tricky to manage. There are reputational impacts, etc. So why are investors adopting responsible investment strategies? So on slide 5, we have some financial drivers as well as non-financial drivers. On the financial side, a growing belief and growing evidence that looking at these factors can help you to optimize your risk-adjusted returns. That's a pretty core and fundamental driver for fiduciaries. Influencing corporate behavior can enhance long-term outcomes. And from a kind of up, if you take it up a level, looking at the potential contribution to the integrity of financial markets as a whole. And this, CalPERS, for example, has put a lot more focus on their engagement at the capital market level beyond just at the individual company level in an effort to try and kind of exercise influence over broader market performance as opposed to just influencing individual companies. So those are some of the financial drivers. There are also non-financial drivers, and it's usually a combination of the two which really lead pension funds and other investors, in our experience, to take a more proactive approach to this area. So some of the non-financial drivers include avoiding risks to the pension plan's reputation, responding to beneficiary pressure to demonstrate social responsibility, and kind of to align the values or beliefs of whatever the, whoever the members being represented by the asset pool are, to align that more specifically with some of the implementation items. Use investments to further an organization's values, or regulatory pressure to address ESG issues. So in 8 different countries now, there is actually legislation which requires pension funds to disclose if and to what extent they're looking at ESG factors. So that was first passed in the UK, it exists in 7 other European countries, and it also exists in Australia. And actually last year it was also proposed to be included in the Ontario budget in Canada.
Ms. Arndt, Jen, would you say that the non-financial drivers are considerations that are fairly common with some of our peers?
Absolutely. Yeah. I think, every organization, as you know, is really different in terms of how it's governed, how it's structured, how it approaches different issues. So it is typically, in my experience, it's often a non-financial driver that gets it onto the agenda. But it's only once a group is comfortable with the financial drivers that an organization moves forward. I think that's typically the order of events. But the non-financial drivers can be very different depending on the type of organization. For universities and colleges, we see a lot of student movements kind of coming at it from perhaps a more activist angle. With union representatives, we see sometimes some of the kind of human capital and fair labor practices coming through, and so there really is a range depending on the sponsor organization.
Okay, so maybe some of our peers view it as kind of like icing on the cake, or a collateral benefit, or is it something primary?
I think it depends also what jurisdiction you're looking at. I think I think that there's a range. To be honest, I think some investors have been reactive, had certain pressure, and then taken certain actions to kind of address the specific requests, and not gone to the next layer of really figuring out, okay, so how do these different drivers impact our different asset classes? What are our managers doing about it? What are the best practices in terms of how we could set expectations for how our managers think about and look at ESG, and we'd like to see them report on that. There are fewer plans that have gone that next level of implementation than there are plans who have kind of signed on to initiatives or made kind of early policies. And I think that's really the phase we're in now. We went through this, the last 5 years, a bit of kind of cottage industry, lots of different initiatives starting, people signing on to things, and now we're into the next phase of, okay, so what does this actually mean in terms of our investments? How does this translate into what we're doing as an investor, how we speak to our managers, the different things that we sign on to, what are our priorities, what do we stand for? That's really the phase that we're moving into now.
Yeah. And I think where you see a balance of the financial drivers and non-financial drivers, where both are really present, that's where it tends to be more the batter of the cake than just the icing. And for fiduciaries like yourselves, the financial drivers really need to be present, and we believe they are. But there's also an element of the non-financial. A good retirement for beneficiaries is you want to focus on the income, but you also want to have a good environment and smooth capital markets operating for them, and ESG can help, we think, make those things come to be. So where there's both, I think it really becomes core more often.
Great. Okay, so looking at the next slide, assessing the academic evidence. So, this is, of course, a question that we get asked a lot. What does the evidence say? So first of all, I think, we're very comfortable making the statement that it's wrong to assume that this approach leads to underperformance. At the same time, it's difficult to make a completely firm case that it is going to add value. I think where you can be quite certain is that ESG offers opportunity from a risk management perspective. And then the kind of alpha argument, how does it add things? I think there is more evidence coming, and of course the past doesn't necessarily predict the future. And if we look at kind of the context of the world that we live in and the different changes that are coming around sustainability and resource scarcity, then it's easy to kind of connect the dots and look forward as a fiduciary and think, okay, so how will these things start to impact the companies in my portfolio? The usefulness of ESG information really does vary by region, sector, and over time. And various factors such as manager skill, investment style, time period are all very influential in terms of looking at the studies and looking at whether there's evidence that ESG adds value. Some of the observations about the research that's been done to date is that, first of all, I think it's important to try and distinguish between styles. So, there is lots of academic evidence looking at the impact of screening. There's evidence looking at the impact of shareholder engagement. There's more evidence coming now and practitioner research looking at the evidence and the impact of ESG integration. And so these things are connected, yet they're different. So I think one of the things that we're seeing now is more research coming out across different asset classes and in different approaches. So on slide 7, you can see the cover of 2 studies that we've done, which are basically meta-studies looking at some of the different academic literature that's out there to date. So we reviewed 36 different studies. We found that 20 of the studies reviewed showed a positive relationship between ESG factors and financial performance. 11 found a neutral link, and 5 found a negative link. Since then, a number of more recent studies continue to show positive relationships, and one of the really interesting things is that we're now seeing more research coming across different asset classes. So, for example, a paper looking at fixed income, finding that companies that manage environmental risks more effectively have better access to capital and lower cost of debt. HSBC, yep.
NYCERS made a report, 36 studies total through 2009. When did it start?
Some of those studies are back from kind of the, in the 90s, early 90s. So it was up to 2009 looking at everything we found before then.
No, I understood, but I wanted to know the beginning.
Yep, I'd have to come back to you on the exact
the
date.
90s, though.
It's mainly the 90s.
Okay, thank you.
Yeah. And Deutsche actually came out with a study this year which provides a meta-analysis which updates also kind of from where we left off. And they take a little bit of a different approach in that they do categorize by the different implementation types. So that's one that's worth looking at as well.
And how would you generally characterize their findings?
They were kind of relatively consistent, positive overall, but of course, it's not a kind of blanket approach that you can just, there are nuances and some differences. Yeah.
But the general
findings positive. Yeah. So slide 8, academic interest in the field is growing. And as some of you may be aware, actually, the PRI has an academic conference that they host once a year. It was a couple of months ago in Toronto, so I had the opportunity to participate in that, and it was 150 people, mainly academics from around the world who are all focused on this area. So it's really a very dynamic field in terms of academic focus. Elroy Dimson, which is, he's a professor from the London School of Economics. He's a kind of very well-known finance professor. He presented a new paper that he's done looking at the 20-year impact of corporate engagements. They had data from a U.S., kind of an anonymous U.S. investor that's been undertaking corporate engagement. And he found abnormal returns, I think, of 1.8% a year based on the engagement activities which that investor had undertaken. So that was kind of an interesting contribution to the academic body of literature. And he actually was awarded the Moskovitz Prize, which is an annual prize for research in this area, for that piece of work.
Now, Jane, I'm sorry to keep interrupting. Now, was that based on stock governance activities, or was that based on screening out?
That was based
risks?
on stock performance, kind of pre, during, and post-engagement. So it was isolating the impact of corporate engagement.
Of the
That this-
engagement, okay.
Yeah. Yeah.
Wow.
So that's, kind of consistent with the CalPERS effect research that Wilshire's done on their engagement program and the impacts of that. And then in the private equity infrastructure space, the most kind of relevant and interesting research that we've seen has actually come from practitioners. And I'm sure there are academics working on this area, but there is a less robust body of academic literature there. It's the kind of practitioners are doing it first, and I think the academics will be gathering the data, and the academic research is underway. So the next slide, 9. This is just one example, so I'm not kind of promoting this per se, but wanted to demonstrate and kind of show to you one approach in terms of putting companies that have better ESG performance, or the sustainability leaders, in a basket, and comparing the performance of those companies against the sustainability laggards. So this study, or this cumulative performance, shows from 2002 through 2010. It's from Sustainable Asset Management, and you can see here 3 lines showing the relative performance of 3 baskets of stocks. The first is the sustainability laggards, so the bottom 20% in terms of their ESG scores. The middle line is the sustainability leaders, so the top 20%, and then the yellow line is a long-short portfolio. So you can see here a material difference in terms of their performance. And this is consistent with a study which recently came out as well from Harvard, looking at the performance of companies, again, in terms of their sustainability criteria over a 20-year time horizon from Bob Eccles, which found a similar outcome in terms of sustained overperformance from the companies that had better scores in terms of sustainability.
And what was the metric that was used for the
That was I believe it's a methodology that they came up with as opposed to a formal framework from one of the research providers.
Sorry, the Harvard study?
Yes.
They took 180 companies and divided it into 2 baskets: high sustainability firms, low sustainability firms, across a series of metrics, and looked at over 18 years, I think.
Right. And it was their definition of high sustainability, low sustainability?
Right. They came up with a methodology in which they put a company in 1 or 2 baskets based on whether they adopted certain policies around a fairly broad range of employment practices, environmental
Right. So there are different studies showing the impact of different methodologies, and I think the real takeaway from that is that it's consistent, from a thematic perspective, and it's there are different ways of doing it and different approaches, and what we're seeing is some of the evidence demonstrating that the broad approach of identifying sustainability leaders, looking at ESG performance and putting that in baskets, one versus the other. There are a number of different studies showing different impacts, but all in the kind of same direction, which is really, I think, the trend that is important as opposed to some of the individual studies. Yeah.
So these trends where you have higher performance among ESG leaders and lower performance with ESG laggards, I've heard that one. To what extent? This doesn't directly comment on causation, right? But there's thought that maybe better performing companies, as they do better, will engage in ESG after the fact, or it could be they're visionary into the ESG, and that assists their performance long term. But can you comment on sort of what you know about those 2 types of causations?
Sure.
And I guess, for example, how the ESG leaders are these, the metrics that are being used to identify these leaders are not designed to just identify the companies that are simply giving out a lot of charitable donations, and that's counting as a huge ESG attribute.
Right, that's a great point. I mean, I think there's a few different elements there. On the one hand, the identification of companies as sustainability leaders, the bar is raising, right? So, in the past, you had a great charitable donation program, fantastic, you were top quartile. That doesn't get you top quartile anymore. Now it's kind of now the dialogue is more around integrated reporting, looking at sustainability as a value driver. Looking at resource efficiency, energy efficiency, water efficiency, and reporting across all of your operations, and really communicating your long-term strategy and linking that with your financial performance and your sustainability performance. I mean, that is what a sustainability leader is, kind of in today's conception. So I think on the one hand that the bar is raising. I think the other thing to be careful of is, we're certainly not advocating just buying a basket of sustainability leaders. There are lots of different ways to think about how investment managers can integrate this information. So I think, what you want to be clear is that, the first kind of fiduciary test is, can companies integrate, these factors, or companies that, position themselves strategically around these factors? Can we be clear that that makes sense as a strategy and that that's not going to detract value from them? And I think, absolutely we can say, yes, we can be clear that that's the case. Then when you move to the next level and you say, okay, well, what is the right way to think about these factors when we invest in companies? And there are lots of different strategies around doing that. I mean, maybe it's getting into the companies that haven't done this stuff well but are on the cusp of integrating it, so that you're going to receive the stock price appreciation that will come because of that, right? I mean, maybe you don't want to just go into the companies that have this information in the stock. Or maybe you do. Maybe you believe that they are the ones that have a better positioning, and from a passive perspective, maybe you want to be in these companies, but maybe you want to have an active approach around those companies that will be changing. So the whole implementation side, I think, is the next step once you get some of that kind of the intellectual foundation and comfort level around your approach.
And so for this slide, it doesn't say it here, I don't think, but Sustainable Asset Management is the firm that does the ratings for the Dow Jones sustainability indices. So it's a wide range of environmental, social, governance, ethic, and economics indicators. So it's not just, it's not just that they have the CSR report. It's a pretty detailed methodology.
Great. Okay, so the next slide, slide number 10, addressing quarterly capitalism. So this, some of these themes are newer to the kind of responsible investment dialogue and looking at how fiduciaries are behaving as active owners, are taking a thoughtful long-term approach to the capital that they're overseeing. But as many of you, I'm sure, are acutely aware, average holding periods have gone from 7 years to 7 months. Our data suggests that institutional turnover averages more like 16 months, which is better than 7 months, but still is not a particularly long time horizon. And there is a growing body of evidence to suggest that short-termism is detrimental and lead companies to underinvest in the future in order to meet short-term goals. This can be to the detriment of individual company performance or individual investors such as yourselves, as well as to the wider market. So what can investors do about this? Looking at the time horizon of your investments, as well as the messages that you send directly or indirectly to your investment managers. And I think that we are going to see a lot more focus on this over the coming 5 years, looking at turnover and how actual turnover may differ from stated or expected turnover. Our research has indicated in a study that we did looking at 2006 to 2009 data. So of course that would be a highly volatile period, and we need to update that research to see the longer term outcomes. But we found that 60% of the managers in our database exceeded their stated turnover, some by a very significant amount. Do manager agreements address ESG factors? Do they address stewardship? Do they look at things like turnover? Would you consider longer-term mandates? So these are, I think, also some questions that investors around the world are thinking about and looking at in terms of how they oversee their funds.
The 7 years to 7 months, that happened over what period?
The last decade.
Wow. Up to this year?
Up to now. Yeah, that's in the New York Stock Exchange. Okay, so the next section is a little bit of a case study looking at the risks from out-of-date risk management. So this actually, this case study was put together by Raj Thamatharam as part of the work that he's done around preventable surprises. So you can see on the slide here a picture of the Deepwater Horizon disaster. As I'm sure everyone is acutely aware, there were 11 fatalities, 17 injuries, significant share price drop, 1-year suspension of dividends, some more recent updates in terms of agreed fines, charges, etc. So how did this happen from the investor perspective? And how does the risk management model in place looking at these types of examples, how could that change and evolve to prevent the next similar surprise from happening? That's really the question for fiduciaries. So slide 13, you can actually see, going back, I think this goes back to 2006, a number of different, kind of arguably related incidents which happened in the 4 years prior to the disaster. And then you can see on slide 14 that only 6 occurrences every 100 pages took place in terms of discussion about these different incidents in the sell-side research, which focused on BP. And then on the next slide, you can see the chart showing the range and the average recommendation from the sell-side perspective. And, basically looking, from a 4, an add, overweight, outperform, to a buy or a strong buy recommendation from the 09 to 2010 time horizon. And really a lot of this trend was driven by the kind of narrative that BP was really a leader in cost cutting, which is, seen as attractive. And I mean, obviously, managing costs is very important. But at what expense, I guess, is the question. So, what's the asset owner angle on this? If you look at slide 16, you can see that only 60% of capital voted at BP's 2010 AGM. 57% of votes were in favor of the chair of the safety committee, even though ISS recommended to abstain and Glass Lewis recommended to vote against. So what went wrong? And, we could spend a half an hour just talking about this slide, slide 17. But really, this is, I think, an important systemic view. So if you look at the outside circle, that's kind of the system-wide challenges or problems. So a weak concern for negative externalities. So this really links up to, there's different terms for it, but negative externalities. A newer term which has come out is stranded assets. So in the new white paper on sustainable capitalism that came out from Generation, one of their 5 recommendations to kind of achieving a more sustainable form of capitalism was to identify and price stranded assets. The concept being that there are more oil and gas reserves kind of on the book and reflected in stock prices today, which can be burnt if we're going to stay within the 450 parts per million that scientists indicate the atmosphere can handle. So if and when carbon is appropriately priced to keep us below that level, those assets will become stranded. And so that poses an economic risk to those companies and the investors in those companies. So how are you managing stranded assets in your portfolio, and how are we managing those assets in the system? How are we identifying and pricing and managing that risk? That's one of the major systemic issues. A narrow conception of risk is another concern, so an outdated approach to safety. Shareholder value fundamentalism, focus on meeting shorter-term earnings forecasts, shorter-term financial metrics, leadership and governance failures, organizational learning disabilities, and regulatory capture are all kind of broad systemic issues which investors around the world are working on in different ways. And I think one of the really fascinating things that we're seeing is more collaboration among investors and the different groups that investors such as yourselves are part of to address some of these broader systemic issues.
As I recall, there was more than one player in this. There was Transocean, and what went wrong was they didn't want to take the time to do it right. Would you agree with that?
Well, and I think the pressure on cost would be one of the drivers around that.
Yes, that's true. But it wouldn't have taken that much more time to do it right. Really?
Right.
What, another, how many hours? And a little more money?
Right.
Did anybody predict, did anybody come to the conclusion that BP was a laggard?
Yes.
Tell the market that?
Yeah, so there are some, and there's been a lot of talk about this within the responsible investment industry in the U.S. and elsewhere. And so there were some firms that had been looking at, for a while BP was the darling of the socially responsible investment industry because they came out with Beyond Petroleum and they were going to invest all this money in renewables. But there were firms that started to look at the health and safety record and see the kind of repeated kind of a visible pattern of accidents, and there were some that sold out before the accident.
Before we did.
Perhaps. It certainly wasn't everyone that says they're looking at these issues that was ahead of it, but there were examples that were able to show that they did.
We lost money on BP, did we not?
This is our chart. On page 13, you own the stock, that was your chart. You own it in the index.
You wrote some lawsuit recently.
Okay, so we should probably jump into the next section, case studies on what some other funds are doing and how different funds are approaching this. So if we look at slide 20, as some of you may be aware, CalPERS is I guess, midway through a very thorough kind of evolution of their approach to ESG, or IESG as they call it, investment, environment, social, and governance, and really kind of the integration of all of those things. And we've been supporting them in certain areas of that approach in terms of really evolving their approach from what was kind of embedded in their public equities to a total fund approach. And with that, they are in the process of developing a total fund statement. They issued their first Towards Sustainable Investment report earlier this year, and I think it's the first U.S. public fund to have kind of a robust annual report on their responsible investment activities. So there are kind of a few pillars here of their approach on slide 20. So one of the things that they're doing is reviewing existing commitments and streamlining their approach. So as part of the work last year, they identified 3 focus areas that they want to put their time into. So those are climate change, alignment of interest, and human capital. And we did an inventory of all of the initiatives that they support, the different policies that they have internally, externally, and there were 111 initiatives that relate in some way to ES and G. So what they are focusing on this year is streamlining those initiatives, looking at where they can add value, looking for the areas which are the most aligned with their 3 identified priority areas, and going through a process of kind of rationalization of those. So prioritizing issues was a big part of this area. Gap analysis and asset class implementation. So they've been looking at their approach by asset class and comparing that with how different peers around the world are implementing in terms of private equity or infrastructure or engagement, and looking for areas that they can learn from, different things that they can maybe do better. Ongoing education. And then developing an internal and external reporting framework. So as I said, they did issue their first report earlier this year, and are working on additional items around kind of improving and enhancing that reporting over time. The next slide, 21, focuses on looking at engaging and monitoring external managers on ESG. So of course, particularly for funds with significant external management, this is a critical area. How are you engaging with your external managers? How are you setting expectations for them around ESG? Just learning about their processes, what they're doing, and then figuring out, how that meets up with what you'd like them to be doing. So there's a few different ways to do that. There are public examples of ESG due diligence, which are available in certain areas. So for example, where you have fund managers that are signatories to the PRI, the Principles for Responsible Investment, they may be making their annual assessment public, or if they're not, it's probably something that you could request from them. There are sustainability indexes and different ESG research firms which undertake portfolio level analysis, so they can go and do a snapshot of the different holdings in different portfolios and give you an ESG score or tell you about red flags in the portfolio. And at Mercer, we also have a framework where we actually rate every strategy that we research. We now assign an ESG score. So this is not based on the individual scores of stocks in the portfolio. It's more process-driven. So to what extent does the fund manager at the strategy level, because, you know, in a firm, you may get a great philosophy about ESG, but it really comes down to the portfolio manager to see whether it's actually implemented. So how does it factor into idea generation? How does it come into portfolio construction? You know, what's the implementation, both in terms of bringing ESG data in as well as around voting and engagement. So slide 22 shows the distribution of our 5,000 ratings by asset class across our 4 ESG scores. So ESG 1 is the light green on the left, and that's the highest score. ESG 2 is the darker green, and then 3 and 4 are the blue components of the different bars. So you can see that it's actually 9% of all of these strategies that receive a 1 or a 2. So only 9% of the universe of managers that we research would be those kind of top scoring managers. So, you know, this is just a reflection of where we are today. And we expect to see these scores improve over time. But the truth is, you can do your CFA and your MBA and not learn a whole lot about how to look at ESG factors. You may not learn that you can get carbon data in Bloomberg. You know, these things are new and evolving.
So Jen, these ratings were based on funds and not particular stocks or debt instruments?
Right, they're based on individual strategies. So, you know, JP Morgan's global equity strategy might have a different rating than their fixed income strategy.
Right.
Yeah.
Okay. So it's based on an investment manager
Yes.
and his fund.
Yes. One manager will have multiple ratings for the different funds.
Yeah, and really based more on the investment process than the actual holdings of any given time.
For the results.
Right.
And when you do your overall rating for a fund or a manager, do you integrate the ESG into that, or do you keep the ESG ratings separate from all the other non-ESG qualitative and quantitative rankings?
We do both. So the individual researcher who's assigning the alpha rating will also assign the ESG rating, and that ESG rating will factor into their outlook on the ability of that manager to outperform to the extent that they feel it should. So in the alternatives asset classes, we do have a qualification that you can't receive an A rating if you have an ESG 4, because we think that just is kind of a no-go zone in terms of a forward-looking ability to add value. But everywhere else, it's at the discretion of the researcher and their view on the degree to which it factors into the investment process and the forward-looking performance. So we keep it separate. On the one hand, researchers will and can integrate it, but on the other hand, because it's a changing area, there are a lot of our clients who want to see that metric over time. They want to compare their managers against the universe, and they want to make sure that that's improving.
So what should I read into, if I look at equity, sort of half of them are in your bottom quartile, if I call it that, whereas fixed income, 80% is in your bottom quartile. Bondholders don't care versus equity owners care.
Does that mean you don't recommend any fixed income managers?
No, not at all. I mean, this is an additional...
Should I get my question answered before you jump right in there? Thanks.
It's a reflection of the reality that there are far fewer fixed income managers who've put a lot of thought into how to bring ESG data into their approach. Although that is an area of rapid development.
And why do you think that is?
I think, historically, the whole industry has grown up around listed equity, and really it's only been the last few years that we're seeing that expand beyond that asset class. So I think infrastructure, private equity, it just makes a lot of sense in those asset classes. You're getting into something for the long term, you need to figure this stuff out. Fixed income, has been more quantitative, has been kind of maybe less related to some of these factors, and I think it's really only the last couple of years that we're seeing a lot of innovation in that area. And it's almost every week or two that there's a new fixed income fund of some type that's launched, and Barclays has launched something, and but it's a very new area. So we will see these bars move over time. This is just kind of a reflection of where the market is today.
And it's parallel with, Jane talked about the academic research developing. A lot of the academic research is out there on listed equity strategies and the impact of screening, and that has evolved, and now we're seeing more, as Jane mentioned, on fixed income and the cost of capital. So they're all evolving.
So, but before you were saying your view is that in private equity, it was scored 4, and that's a serious indicator of future performance, but that was the 4 is not applied in that way to the other asset classes in your framework.
It's not right now, and Mercer, we're a big organization. We're 1,200 people, I think, in investments, and we are a microcosm of the investment industry, right? So, I think that that's an honest reflection of where we are in terms of how kind of formally these ratings factor into our broader ESG research. So that's the one kind of mandatory relationship that we've put in place so far. And in terms of how researchers integrate the other factors and have the ESG considerations influence their alpha ratings is at their discretion. And it may be next year that we add kind of more rules that function into that, but that's kind of an internal dialogue which is underway. We do have clients who say, look, we're not going to hire a Forbes. Like, we want to look at our manager universe will be ESG 3 and above. That's kind of setting a minimum standard of expectation. And where you have existing managers that may be a 4, doesn't mean that you're going to go and get rid of those managers, but it may mean that you formally communicate to them what some of the best practices are around ESG and some of the things that you would expect to see from them over the coming quarters and years in terms of their practices, their resources, their reporting.
And would you say that these rankings have different significance for different asset classes? Just kind of what I was saying, just to confirm, a 4 in fixed income or just random, I'm not suggesting an actual idea, a 4 in fixed income is less important than a 4 in hedge funds.
Yeah, I think it's even deeper than that. I think you really need to look at what the strategy is. Beyond the hedge funds. It's so broad. Within that, what is the strategy based on, and what's the relationship to ESG? What's the opportunity?
So, yes, Jimmy, I think they're completely different things, these asset categories.
Yeah, no, that's what I'm saying.
If you're a private equity firm or a real estate firm, you actually own something and control it and control everything about it. So if you own a building and you want to put solar on it, that's good for ESG, but you control it, so there's no governance issue. If you have green, then you're going to be scoring A. Whereas if you're a slumlord, you control the building, but you decided overtly to be a slumlord, that's bad, right? So you can see that pretty clearly. Just like in private equity, if you buy a business, the G is off the table, you are in control. You have perfect alignment, you can fire, you can hire, you don't like them, you can do that. Their comp is generally directly tied. So if I look at what we try to do in our proxy stuff for public companies, you have no battles in private equity about alignment. You might have a battle of environmental with a private equity guy. So I'm not surprised that you find that people with the most control over their investments, private equity and property, generally have the smallest bottom quartile. Similarly, if I look at bonds, those guys view themselves not as owners, but as we have contract. It's a piece of paper. We're just going to get our money back. And we view ourselves as we have no control over anything, period. That's different than the public equity guys who, kind of do it through proxies. So, it's hard, I think, even though we own all these things, they're very different beasts.
No, exactly. That's why I asked the question. I was just trying to clarify. partly in response to Martin's question, if fixed income is mostly fours, does that mean we are not supposed to invest in fixed income? And the answer is definitely no, because it depends on the asset classes, and as Jane is saying, it also depends on the specific strategies or management within those asset classes. So
By the way, a lot of
these rankings are not meant to be, while some of the commercial clients may be using a more rigid approach, fours means the same thing for everyone. That's not necessarily the purpose of these ratings.
And without putting words in Mercer's mouth, but at least three quarters of the core fixed income investment grade universe are government securities. So it may or may not have the same relevance to the rankings that you're looking at. I'm not sure what that means for a four if they're government securities, but it may impact the numbers that you're seeing here.
Okay, so if you look at the next slide, this is a snapshot of the ESG ratings where we have them in place on your external active equity managers. And so this is based on number of strategies. If you did an asset-weighted kind of proportion, I think you'd see a higher proportion of ESG 3 and 4 because some of your specialist kind of environmental managers will have a higher rating in this kind of scoring.
This is by number, not by dollars.
Right. Okay, so the next slide, 24, climate change. Climate change is... Yep, sure.
How come you only did the active equity manager?
We were just kind of taking a snapshot. We could include the passive. I mean, the passive obviously gets scored on active ownership.
It's such a large part of the portfolio.
Right. I think there's just more differentiation here in the active.
If I can, let me just follow up on that question. Michael can help with that too. If we have a passive index manager, do we tell them to use the index but try to be activist and environmentally or ESG sound?
Not if
With
it's
an index, you can't.
Not if it's just a passive index. You own the Russell 3000, all of them.
Yeah, so why would we even care about really going the ESG stand on?
Well, I think there are two dimensions to the question because we retain all of our ownership rights for the underlying portfolio companies and very actively engage in whether or not they are in the passive or active portfolio. But passive managers, they have a lot of discretion over other people's money, right? So while your passive managers don't vote your shares, they still exert tremendous influence over their portfolio companies because they do have discretion over other people's money. So how they choose to exercise that influence will vary from one passive manager to another.
But my question is, if we hire somebody and say invest in the Russell 3, and that's their mandate, and that's how do we then turn around and say, well, we want you to invest in the Russell 3, but we also want to count again what you do with your other people's money.
Well,
that's what I'm asking. I don't know.
I think that it's not, passive managers are not homogenous. You can have three different Russell 3000 managers who have a very different philosophy about how they manage risk or create value within their portfolio, and that may be a criterion against which you would want to evaluate. I assume that's what you do. I assume you have ratings for passive managers, and they're not consistent.
Right. And I think that's exactly the point. I mean, when you're a passive manager, your only tool is engagement because you can't sell. So you could engage at the company level and you could engage at the capital market level. And so even though you are retaining your ownership rights, I think it's a very fair point, you may want to look at, the quality and the philosophy of the manager that you're hiring around their engagement approach to make sure that it's aligned with your own. And then, the other area when thinking about passive is, what about ESG passive indexes? That's an area that we haven't seen a lot of focus in the last few years, and I think we are going to see more focus. There are a couple of large funds who are, right now figuring out how to create an ESG passive index, and, MSCI, Dow Jones Sustainability Index, Janssy Sustainalytics, they all have ESG versions of the broad market indexes which are available. Some of them have 20-year track records, and I mean they're pretty much spot on in terms of the performance, against underlying indexes. So that's another area I think kind of worth looking at as a passive investor as you kind of go, down the ESG path.
But that's a product. I mean, again, we have $40 billion of passive equities.
Yeah.
What you just described is a product for us. It's not all of our passive equities are going to all of a sudden say we have to exclude these 20 or 30 companies, are you?
No, absolutely. I mean, you'd have to kind of do the work to figure out, okay, what are the different ways that are, out there in terms of constructing passive indexes. And the ones that I think, I would encourage you to look at aren't just taking 20 or 30 stocks out. I mean, they're looking at a more kind of fundamental approach to looking at, constructing indexes which include sustainability leaders.
Forgive me, but that sounds more like an active product than a passive. I mean, then, and I assume with that comes with additional fees and additional risks as well.
I mean,
I'm asking.
Right, to be honest, there isn't a lot of institutional kind of product that's been built around the ESG indexes.
Okay.
But it is coming, and it is meant to be, you are in a passive vehicle where you're replicating just a different underlying market index, which is constructed in a different way.
Right, so MSCI has a series of ESG indices that they base off their broader market indices, and they take the best ESG companies from the broad market. They optimize to mirror the risk and performance characteristics of the broader index, and they have an ESG index which is the top sustainability companies from the broader index. So similar risk and return profile, but it is there's a level of active approach to get to that new index.
How do the fees compare to a truly passive index?
They're in the U.S. They're actually limited investable products. The fees are maybe a little higher, to be honest, than a regular passive product, but it also depends on the offerer. And I would say, someone like NYCERS, if this was an area you wanted to explore, you can probably have a say in what the terms will be in some of these managers that are figuring out if they're going to come up with a product. There's not tons out there right now. So if there was something specific, a specific sub-asset class or a specific risk-return profile, I think there's an opportunity for large investors even to get together and say, this isn't out there. Is this feasible? And what would the fees be?
And I mean, it's not something you go all in right away, but it may be an area where you take a little bit and you do some innovation. You look at the opportunities, you put a little bit of money to work, and you see how it goes. And over time, maybe you top it up or you take a little bit of a different approach. So it's kind of one of those opportunities, I think.
Yeah, and I'm sorry,
have we done that initially with you?
Perhaps.
Okay. I was just asking if we had done some of this in the past, where we had dabbled in and started some processes.
Okay. The fees for existing products certainly aren't active fees, but they may be, a few basis points higher than their passive product fees.
Okay, I think we should jump to slide 24. So climate change. Climate change is, a big issue in my view, in terms of how we are going to manage, the kind of our global finite resources and the way we're using them and the way they're interacting with the environment and how that will impact our economy as investors. So a few years ago, I guess, we started what is, I think, was the world's first kind of robust study to look at the potential for different climate change scenarios to impact capital market performance at the asset class level, and look at the opportunity that institutional investors have to optimize their asset allocation in the context of those different scenarios. So on the left-hand side, you can see the front cover of the public report that we issued in 2011. And it's at mercer.com/climate change if you want to see. The full report is about 160 pages, but there's a much shorter executive summary. This project was done in partnership with 14 of the world's largest pension and sovereign wealth funds. So from the U.S., it was CalPERS, CalSTRS, and the state of Maryland. And we had the governments of Norway and Singapore, APG, PGGM, a number of other international pension funds. It started with the Stern report, which was the 2006 report which did the first economic analysis of climate change. And we actually worked with Nicholas Stern's team, who are part of the Grantham Institute for Climate Change at the London School of Economics, to build out 4 different scenarios about what might unfold in terms of climate change. So just in brief, the 4 scenarios were Stern action. So if we did everything that Lord Stern suggested, that's one scenario. Another is regional divergence. So different countries and regions take different approaches, but we don't have a global framework. The third is delayed action. So the world doesn't do anything until 2020, at which point there are a couple of major events like Sandy and like others which change public opinion, at which point there is a global agreed framework. But because we've had another 8 years at this point of bad investment decisions which haven't included the pricing of externalities, that delayed action scenario is the worst for capital markets. It's the most costly. And the 4th scenario is climate breakdown, where no one does anything. So we optimized over a 20-year time horizon because even that, as you know, is a very long time in terms of actually setting asset allocation. And we had some very interesting findings. Now, this other report covered through the Looking Glass. A year after the study came out, we went and we talked to the 14 investors, and we said, okay, what are you doing as a result of having participated in the study? Are you changing your asset allocation? Are you engaging more? 80% had increased their engagement with both companies and policymakers in terms of advocating for a more robust approach to climate change. And actually today I saw that a global press release ran out collaboration between the Investor Network on Climate Risk, the other 3 regional groups, UNEP-FI and the PRI, with a global investor statement going into the climate negotiations in Doha, which are starting next week. So there is this kind of annual engagement by investors into these climate negotiations. But to be honest, progress is not being made at the pace which it needs to be made to actually achieve something. And I think there's a big opportunity for the financial community in many ways to become more involved in addressing this challenge. And I think, we are seeing a lot of conversation on this, and I think that we're going to see kind of a ramping up over the next couple of years of engagement by the financial community in addressing this major systemic risk. So the next slide shows the different reasons to consider ESG across asset classes. So this is basically one of the key recommendations that came out of the climate change study was to increase your exposure to climate-sensitive assets. So these are the assets which will benefit from a transition to a lower carbon economy, but at the same time will give you kind of downside protection against that eventual pricing of carbon. So when, under the delayed action scenario, the carbon price was $220 a ton. So if you've got a lot of brown assets in your portfolio versus green assets, those will be disproportionately, negatively affected when that pricing comes into place. So that recommendation has been taken up by about half of the different investors involved in the first study, but it's practically a very difficult recommendation to implement because a lot of the managers where we see the most opportunity in unlisted markets, and a lot of the managers who are looking at the sustainability themes across unlisted markets, maybe newer managers, maybe in regions that it's harder to get access to. So it's been a challenge in terms of actually putting money to work in this area. I think NYCERS had some commitments around investments to clean energy, and I'm not sure those have all been kind of fulfilled, again, because of implementation challenges. So this is an area where we're really ramping up our research on those types of investment opportunities and trying to put together solutions for investors. So slide 26, insights from our experience with the implementation of responsible investment programs. There are challenges. Let's be frank, this is not an easy area. It covers a lot of different topics. There are a lot of different kind of drivers. A lot of investors today such as yourselves, have done, a lot of great work in different areas. But there may be multiple commitments that are out there, and, it's both a bottom-up and a top-down reconciliation. I think that often needs to take place, as in the case of CalPERS, as saying, okay, what is our vision around this? What is really our strategy? How should we prioritize the different areas? What's important to us from a financial perspective? Are there non-financial drivers that we need to be cognizant of? In terms of the lessons learned, buy-in from leadership is crucial, as well as throughout the organization. I think, in particular in the U.S., there's often a kind of separation between the governance teams and the investment teams, and I think having those groups work together more closely is one of the things that we're starting to see. Multi-stakeholder committees seem to have a lot of benefit in terms of bringing these things together. So having individuals from the governance teams, from each asset class, from compliance, from legal, from the board, to kind of work through the implementation of these opportunities, the follow-through and monitoring by the board, external reporting, all important. The next slide just kind of has
That's 26. Do people do ESG on themselves?
Pardon me, in terms of...
Starts at home kind of thing? Do people critically take a step back and look at their own, as money managers? I mean, as CalPERS, let's say.
Yes, well, CalPERS they're going through a process of looking at their internal governance, trying to make sure that they have all the different kind of charters in place and reporting. I think it comes down to the individual organizations. There's certainly something to be said for, practicing what you preach.
Right.
I'm not sure it always happens, but there are some cases to look at.
And I would think you have to start at home before you start preaching it.
Right. And, one of the things involved with the PRI, as you guys know, is mandatory reporting now. So reporting as organizations on how you're implementing ESG, but that won't always speak to, your own internal governance. So your structure, you've obviously made some commitments, involvement with PRI and INCR, shown a lot of leadership on governance, and I think some natural priority areas already exist. You've got a lot of managers, certainly, and probably a significant range of activity and investment beliefs among those managers. So just quickly moving into the next section, slide 29, it's really how we think about laying the foundation for developing a responsible investment program. So preparation and education, of course, are important. Background research, training. Sometimes we work with investors to do some peer benchmarking. So, what are the exact differences in practices between myself and, say 5 or 6 peers? And then setting a strategy and a policy. So what are the goals? What are the expectations for external managers? What resources are available? How can you work with the other funds, perhaps? How can you leverage the areas of expertise you already have and maybe bring those to bear across different parts of the investment organization? And then that, of course, leads into implementation. So, voting and engagement, there's already a robust program in place. Manager reviews, asset allocation. So, I'm not sure where you are in your asset allocation process, but thinking about exposure to the sustainability type themes, looking at things like climate change in terms of how are you positioned today versus where you might like to be more optimally in the future. Possible search and selection, so are there new kind of thematic exposures you'd like to have in the portfolio? Which asset classes, how would you kind of integrate those? And then monitoring and reporting. So what kind of reporting do you already do in this area, and where would you like that to get to, from a total fund perspective? So those types of considerations lead into a responsible investment program. They may result in specific policies, or you may say, look, we're a PRI signatory, that is the kind of policy we want to follow, and let's embed that. So I think there's not a one-size-fits-all approach. It really depends on the individual organization, whether, you just enhance your existing statement of investment policy or you develop something that's supplemental. There's a lot of different kind of ways that you can do it. So slide 30, I think, just shows what we consider to be the key pillars. So at the top, once you have that vision and strategy, there's really three key categories of implementation. One is looking at external managers, so setting expectations, monitoring them. The middle is around voting engagement and collaboration. So, what are the different initiatives that you're part of? How intensely involved are you in those organizations? Do you have the mix right in terms of where you spend your time and where you spend your money? And how do you actually end up spending time from a thematic perspective? What areas do you focus on the most in your work? And are those the areas that are the most important to you? And then new allocations. So are there, additional types of investments you'd like to see in your allocation? And then staff, and that should really say staff and resources. So, are there research inputs that you would benefit from that you don't have? You have staff working on these areas, but do you need more staff? Or should you have, allocations of individuals' time towards participation in a broader ESG committee? How would that be governed? So those types of opportunities. Slide 31 is a little bit of a mapping of some of the different kind of tools and where we see them falling in terms of early stage implementation, later stage implementation, and on the cost kind of range. So education and RI research, what we're doing today, would, I think, fall in that category. And there is, a tremendous amount of literature out there now of case studies and articles and studies. I mean, so much so that it's kind of overwhelming. But you can get a lot of research and kind of implementation ideas for free. Moving over to the right, including language in RFPs and even in manager agreements. There's sample language, that other investors are using that you can access and look at. Research services, proxy services, collaboration. Some of these things are inexpensive, but of course, if you get really involved in things and spend staff time, it becomes more expensive. Full-time staff are, of course, in the expensive category. New investment mandates. But engaging with companies and managers can be done kind of in a resource-effective way, but also can be done in a much more robust way. So these are kind of some of the cost opportunities. And then the last slide, slide 32, we've put together kind of what we would see to be some early stage and later stage opportunities. The education and discussion is underway. Is a sustainable investment strategy something you'd like to develop? Or is the PRI sufficient, I think, is a question. Are there priority themes that naturally rise to the top, or is that a more robust discussion that you need to have? What kind of expectations are you comfortable with in terms of setting for your managers? And then the next stage would be kind of implementing the due diligence. So how do you track performance? How do you set goals of continuous improvement? How do you think about ESG and sustainability and the resource revolution in the context of your asset allocation? And are there opportunities to kind of enhance or, kind of prioritize differently your engagement activities and how that connects in with your overall strategy as an organization? So that is a lot of information. I think, we covered a lot of ground. And I think, this field is really exciting because I think it's very important for fiduciaries to look at these drivers. And there are a lot of opportunities, I think, to really have an impact in terms of how the industry is changing and shaping around these different themes. And I know that NYCERS has shown a lot of leadership in this area already, and we're interested to see what your next step will be. So very happy to take additional questions at this point.
A wrap-up question?
Yeah, could you describe the infrastructure that CalPERS has put in place to start implementing their program?
Sure. So they have their global governance group, which has been kind of elevated from within listed equities across the total fund. They have a lot of involvement from the kind of, the senior investment staff, senior operations staff, compliance staff. They have a cross ESG working group, which involves individuals from each asset class. So they have both kind of their traditional governance team working on it, as well as now a much more holistic integration with the total fund. And then they have, consultants such as Mercer and academics, different organizations supporting different pieces of their work program.
So their corporate governance program, which was engaging
companies, they've integrated that into the structure, and that, I assume they have, they hired additional staff for that, or, well, how did they?
I'm not
they
sure how
handle
their
that?
total staff numbers have changed. They do have a new staff person who's joined from the PRI, and she's one of the project managers coordinating this whole area, and they have actually 5 work streams that they're working on. So total fund integration, I'm not going to remember them all, but integration, into the different investment organizing, the different asset classes, governance and company level engagement, capital market engagement, alignment of interest, and
Oh, wow. Okay.
and one other that I'm forgetting.
That's pretty broad.
It is, and they're really kind of trying to be more organized in terms of those different categories and reporting on the different work they're doing in each of those 5 work streams. And actually, Ann Simpson presented to the board last week their global governance approach. And so there's an update on those 5 work streams and all the steps they're doing in each, and that's available on their website. I'm happy to send you the link.
Very good.
Al, I think you could benefit from seeing exactly what resources CalPERS has, not just in this, but overall.
Yeah.
Before you go pick off one little thing to focus on, you should see how big CalPERS is, staffing.
I mean, they have a lot of internal management, so a lot of internal staff.
It all fits together.
Well, thank you so much for your generous offer of your time today and for flying cross-country on the red eye to come and talk to us.
Yes.
We do appreciate it. Having both of you here, this was very informative. Great.
Thank you very much.
Thanks for having us.
Thank you. Did you have something to say?
Well, there's going to be something in executive session where we pass out. Thank you. Yes, it was a good meeting. Yes.
Okay. My points for today, Larry. Am I?
Can I just ask Larry?
Did you bring this book?
No, we collect, a number of us got together.
Whoever did it was good. It was thoughtful things. I was just trying to figure out who organized. But I thought it was thoughtful.
Like Al, Ray, me, the 2 Rays.
If I can just ask a question, because I'm not familiar with the investing universe the way many other people here are. And
Second motion for me.
I'm trying to figure out where everything hits. Mercer is not, I assume, a not-for-profit. They didn't make money and having to do this. And I want to figure out where their approach is coming from. What do they do? They offer advisory services on this?
Outsourcing investments.
Yeah, and I understand, that's a broad term, but do they offer consulting services on this? They have a product that they sell that's in this area, or they do a reporting service as well? Or
They're primarily consulting. They don't have a product as far as I
Well,
know.
they rate, as they stated, they rate investment.
Okay.
They're just like Callan.
Okay, that's what I want to be sure
That's
about.
what they do. They're Callan plus some other verticals that they focus on.
They sell their manager research.
Okay, that's what I just wanted to know, because it helps me see where everything is coming from.
That's what they're.
Thank you.
I have a different kind of question. It's kind of similar as a person that's kind of a novice at investing, besides my own little kids. What are the folks, and there's so many different things that you have to know in terms of to be able to contextualize these kind of discussions. Like the whole discussion that you guys were having about CalPERS and what they're doing, what their metric is, or how they apply to CSG. But I was just, I don't even really know where to start. How does this stuff affect what we do? What are the people that are the Davids, the Larrys, the Jimmys, the Al's, and what does this stuff, what does this do, and how does this affect how we should be getting approaches? I think some of this stuff is obviously critical to think about, but how do you apply it in this big world and universe when we're making decisions on the fly to get someone?
I mean, if I can take a cut at that.
You let me finish my question.
Yeah. Okay.
Go ahead. No, I'm just going to, I'll be back later.
Okay. I think, as she said, this is really an evolving field, and that no one has figured this out yet, and that some of our peers are looking at it and trying to figure it out. And it sounds like CalPERS has probably had the most comprehensive approach to this. They are, as I understand it, they're trying to figure out how to apply ESG factors to all of their investment, strategies. And I think what
this subcommittee, some of the conclusions we've come to is that, yes, we don't know how this is going to end up.
Does CalPERS do more internal investing than we do than our BAM folks do?
Yeah, they do have.
Yes.
That's why I said, yeah.
So how do we tell our investors, how do we develop a paradigm for the people that we are, our money managers, how do we develop a paradigm, an ESG paradigm for them? I guess I don't understand.
That's a question. Yeah, let me take it to the beginning, perhaps. It's a good place to start. So if you think of what the most fundamental thing is, that we own pieces of paper, stocks, bonds, right? That's all we own, so it's paper. And we're a long-term 40, 50, 60-year vehicle. Are we supposed to care more about each piece of paper, or do we think we can help each piece of paper? So you get into the ESG. What's ESG? Actually, I start with G, which is governance, right? So we own this piece of paper. Each piece of paper comes with a vote. We have a voice. We should use our voice. That started probably active in the 70s, probably. And big institutional shareholders started using their voice, and it's got louder and louder, and change happens, right? So that's where the G came from. That's why something like private equity, where you control the whole company, you have governance, right? Or money has governance with it. Then you go to the E, let's say. E is sort of like, if you have a company that brought you Love Canal, that's probably a bad company. We don't like that company. Why are we investing with these guys? And before you know it, the E has a whole voice of its own also. So you can look at BP and say, these guys haven't been very good with their business. Is there some way that we can have our managers stay away from the bad E people? And then along the way, big institutions like us have some social issues, hence ESG. I would tell you the G is the most developed. The E falls into fairly obvious. The S is, depending on each investor, what you'd like to prioritize. Then you get to your questions. Okay, now I understand what ESG is. How do I get my managers to focus on it by asset class? And that's what Al was saying. Well, that's not, we're trying to figure that out. Everyone, when I say we, all investors are trying to figure out how to get the most bang for their buck and the most influence over the outcome, because at the end of the day, the pieces of paper, as they said, you used to hold a piece of paper for 7 years, now you hold it for 7 months. We're here forever. So we care about the E and the S, and we use G primarily now to do it. But maybe we're supposed to say, as we sometimes say, philosophically, let's say, we don't like tobacco. So we tell our managers, don't buy tobacco stocks. That's a statement. Don't do that. We don't like that. Or guns. We don't like that either. So they know about our simple rules, but okay, that's what I'll call obvious. But there's, 3,000 stocks in the Russell 3000. We just talked about 6. So can we impact the other 2,994? And how do you actually implement that?
Well, that's my question. I appreciate
but that is the question. It's not obvious. So Mercer is just sort of, that's what CalPERS are saying. Well, let's go figure it. Everyone's trying to figure that out. And is there value to it?
As a new person, there's a couple things to me that seem simple. It seems like if there are companies like BP or bad actors around how they're treating their persons and their workers, if they've had accidents like they've spelled out, it seems like to me that at least in that world we can identify who those are pretty quickly.
No, hang on. That's not.
To me.
It's not. Because what your money managers say is, now it's cheap. Now I can buy some. So you might say, well, I don't want you to ever buy it. Well, that you're way up here saying, I want you to redline this company. Well, do we have the ability to say we don't like that company? I don't know. That's a whole department to say these are bad companies now. But that's where you...
There's a lot of things between redlining and...
We, and I'm sorry, my comment, run the governance program. The reality is that NYCERS historically continues actually to be much further along than most investors, much more active. You, like most of your peers, and more, are indexed and own everything, and I think for a lot of the right reasons. And so the only way you can protect and create value is not necessarily to say, oh, we don't want the VPs, because then you're paying people to decide who's VP and who's not. You might be right, you might be wrong. But to say, how do we identify risk and try and change the behavior of those companies that have risk? And we actually are you were among the most active. We did 60 proposals a year, which is down from what you did, more than anyone else ever does. And those are on environmental practices, on social practices, on governance practices. So on sustainability, we've pushed a lot of companies just to be more transparent across the spectrum, do sustainability reports using the Global Reporting Initiative, which is a somewhat rigorous quantitative framework. And we've got real estate companies that own properties in New York who want to be more energy efficient, more disclosure so you can assess risk. I'm going to be into the full board meeting next month, and I can talk about, last year's proxy committee recently, we had our meeting. And so we're doing what we can. Maybe we could do more different, but I think that's the area where generally it's more developed, and here it's particularly developed. And as Larry said, it's sort of, okay, you either explicitly already have that sort of philosophy and focus, or implicitly. What's that mean as you think about the other pieces? And I don't think CalPERS has put a lot more resources into thinking about it, but no one is really programmatically can give a clear answer about what it means.
You can take some of your ESG beliefs, and by the way, you need to have beliefs that everyone agrees on.
Beliefs scary.
Right? But you can take your ESG beliefs and say, we should invest in timber. And that is a big, that's asset allocation. Let's buy $1 billion in timber. We like timber. Okay, you can start way up top with beliefs and green, put it like that. But then you get into the real nitty-gritty of execution on stocks. That's why it was so interesting to me that the bond guys don't care. They have a contract. Give me the money. I don't really care what the hell you guys do. I'm a creditor. Well, all right, now you want to evaluate the creditor. You should know this guy's bonds versus that guy's bonds. I don't know if that works. That's not what fixed income is. So that's why it doesn't fit everything, but again, it goes back to you're the owner if you own public equities. But you've got to have beliefs. I'm not quite sure we all have beliefs that we've talked about. Since I've been here, we haven't really gone through beliefs other than we have some that are in documents that I understand, but we haven't sat around and formulate your beliefs before you then figure out what you want to do with them.
So could the committee perhaps talk to us about...
Can I throw out a little bit more background for the board and just make sure. So one of the beginning, I fully agree, Larry and Michael completely we're on the same page. One of the other beginning points is that we're a signatory of this initiative called PRI, Principles for Responsible Investment, which is sort of affiliated with the United Nations. We're one of the early signatories to it, along with a lot of our peer funds. And as a signatory, that means we've committed to these actual principles. It's about 6 or a dozen principles that say we'll try to promote environmental ESG. So formally, as an institution, we've already committed that we'll try to promote these principles. How we do that is very open-ended, very flexible, completely in our discretion. But I think, I would say, that's the starting point. And we had, Ken, before you were on, one of the heads of PRI come and speak to us within the last year, which is helpful. And in terms of implementing an ESG policy, we've already done some of that. And I just want to clarify, there are two levels of ESG work. One is what Michael Garland does, which is corporate governance, and we're very, very lucky to have Michael as really one of the leaders in the nation.
How come he doesn't come to more meetings?
He's so busy. He's busy with projects. We don't let him. Can't commend the controller enough for being able to recruit Michael. He really is one of the leaders globally on this, engaging companies at the company level. And NYCERS has been extremely active and a leader. But I think we've also been a leader, but not as developed with corporate engagement, is policy for managers. And how we can promote ESG considerations with our managers and our selection of managers. And we've already created a little bit of policy in that area. Some years ago when we created the ESG questions for RFPs, which came up earlier. And then today, I think, in the recent discussion, we're going to look at questions for private equity. And these are simply questions where we ask managers, look, how are you thinking about ESG and what are you doing? And we're not setting up any strict metrics. So that's just as further background. So I'd say so we have some ESG policy there. And even with those policies, which are just a couple of parts, we're actually pioneers with those measures as well. And so here, I think this meeting was to help really get one of the last slides here, I was talking about buy-in from the board and getting us on the same page to move forward.
You guys are always patient with me, so
Just a
That's what
quick,
I do with people, I appreciate it.
a quickie, Mike and John McCarthy from the Common Fund worked together and had a massive effect on Massey, where 29 people, I think, 29 people died in that coal mine. And they worked very hard, and a lot of changes took place as a result of their work. And it was good work, and I'm proud of you for
It's a
it.
story like these people reporting poor practices to the destruction of life and value and activism. But this year, NYCERS and the other funds, Chesapeake is there wasn't loss of life involved, but it had a lot of the similar characteristics and helped to change that forward. So, we are, active. We continue to be very active.
In terms of where we are with our subcommittee who is focused on this issue,
Right.
can the committee members please give us an update and let us know
Sure.
what the next steps
Why
are?
don't I try that? So, prior to this meeting, we developed a draft action plan about how we might go about, implementing some of the principles into some of our asset classes. And the subcommittee had a discussion of that draft, and it became apparent that we really needed to get someone like Mercer to come in to provide a very broad overview, and I think that was accomplished today. And I think what the subcommittee is going to go back is we're going to go back to the drawing board to see what amendments we need to make in this draft action plan, and we'll do that, and we'll bring it back to the board for discussion. And maybe that won't happen next month, but it'll happen no later than I'd say the second meeting. I mean, we would like to be able to do that in next month's meeting, but I'm guessing we won't be able to do that. That will have a little more work to do than we can do, particularly because of the holidays.
Thanks for the update, and thank you, committee members, for bringing
Thank you.
It was very educational, and we look forward to seeing the output of your upcoming work.
Thank you very much.
So, Larry, are we back?
Let's go back to the first item, or the second item, which is September results. I'll go quickly because it's in November, and they're old, things have changed, so it's a little bit like reading history.
It's not a bad thing reading history.
It's not bad when it's a good month reading history. But I don't want you to fixate on the numbers because it's down since then, so it's old history.
Oh, I think it's the state capitalism.
So what happened in September, just to go back to history, for those who forgot what happened in September. In September, the ECB announced that they were basically all in and they were going to stop having the bond market determine the cost of debt for countries, and that they would be big buyers of debt, so that countries like Spain and Italy could issue debt at lower rates. So that was very good. Then 2 weeks after that, the Fed came out and said QE3, which is we're going to buy $40 billion a month of mortgages, and we're going to keep rates low until the middle of 2015. So that was good. And then everybody said, all right, the next thing is the U.S. election, which I'll get to in a minute. So September had two risks taken off the table that were bothering people during the summer. So if I jump you all the way to page 40. So two good things happened, and the stock markets liked it. So if you look at the far left-hand column, U.S. stock markets are up about 3%, and international markets are up about 6%, and all the fixed income markets are up. So September is just a good month. However, then you're wheeled into October, which is the next page 41, and some of the bloom came off the road. The economy hiccuped a little bit, some numbers. The presidential election became closer, so people started worrying about what the hell's going on in the U.S. So that led to more volatility and gave back some of our profits, basically, in October. Then we had the election in the first week of November. Obama won more than people thought, so now we're going to focus on the fiscal cliff. No one knows what's going to happen with the fiscal cliff, other than we're all going to worry about it. So worry means volatility, so stock market goes up and down 200 points a day. So again, these are September numbers. If you go to page 42, you'll see that all the markets go up, we make money. So again, on the far left-hand column, we made about 2% in the month of October, in the month of September. In the month of October, we probably about break even. In November, it's down probably 2%. And until we get the volatility taken care of, which is really until we get the fiscal cliff sorted out, which is, you're all half of you politicians, I don't know, you guys are better than mine. Until that gets sorted out, the markets are going to bounce around. We'll make some money, we'll lose some money, but not very much dramatic will happen. If you look at our asset allocation on page 36, pictures. So we came out of September, everything was in this range except for tips.